Hey guys, Charlie Jewett here from renovatingretirement.com. Let's get this webinar started. We're just going to do a short webinar here on the three, easiest improvements you could make to a retirement plan, something that everybody could implement with our help. We've done this now, over 1,000 times. And I found that these three changes are the things that will give the most impact inside of a retirement plan, and it's very easy for us to do this for really anybody who's watching this webinar. So the three simple improvements are going to be, we want you to pay less taxes or lower taxes. So we're going to reduce your taxes. We want you to have higher income. A lot of times we can get you 10, 20, even 30% higher income than you currently have. All of that with taking less risk. The idea is not to just put all the money in your life in the stock market and kind of hope for the best. Hope is not a retirement plan. So let's jump right into this, and get into it. So what I do in the world, just so you know who I am, is I'm an author, so the first book I put out is on the 2 ways to be debt-free, kind of a different take on home mortgages, which we won't talk about that on this webinar. And then the Renovating Retirement book, where I was calling the industry and also retirees to kind of repent and change their thinking in this area, because some things have changed. I'm also a TV personality. I do TV presentations. I do a lot of interviewing on podcasts where other people are interviewing me on their podcasts. And my kind of the heart and soul of the movement is the Renovating Retirement podcast. No charge content for you to go and learn how to build your own retirement plan better than any advisor can do for you. So there are some things you can't do without an advisor, and we'll offer our services and help you there. But no advisor should really tell you what you want your life to be like, how much income you want, whether you want your spouse to have income if you die, if you want to pay for medical expenses, or you want someone else to pay for that. You'll see the podcast has a ton of 5-star ratings. It's just good, pure, awesome content for you to go listen to in the comfort of your own home if you want to hear some things before you come in. Now, speaking of homes, I did not grow up wealthy, so I didn't come from wealth and say, hey, here's everything I learned in my childhood. We grew up very poor. I had half a house. So if you look at this picture on the right-hand side, the right-hand side of this was our half of the house, had half a house. I also had a half a bedroom. How do I know I had a half a bedroom? Well, I had a wall that was put up in the middle of the room that went into the middle of the window. And that's not really how the builders build houses, right? So I had a window to my brother's room, and then a wall that went right into the window, and just enough room for a twin bed. Also had half the stuff you'd need for breakfast. We usually couldn't afford milk. So I had cereal and things like that with, water, with orange juice. It wasn't super yummy, but sometimes it's nice to not eat it dry. And I say lightheartedly sometimes kind of half a family. I did have a dad, but we only saw him every other weekend. So for the most part, it's just mom and 2 boys in this half a house, and I had a half a room. So grew up kind of poor, happy for everything I had, but it's one of the reasons I care so much about money. The biggest chunk of our money goes to taxes. I don't know how anybody attempts to do financial or retirement planning without talking about taxes, particularly where we are in this country with taxes most likely going up. But let me just show you something that most people don't get a clear picture on. What's the highest tax rate we've ever seen in the past? There's a book called The Power of Zero by David McKnight, and I also interviewed him on the podcast, and he talks about this time when Ronald Reagan was making movies where tax rates were much higher than what we've seen. So if you look at this picture, on the left-hand side is the percentages, the rates. So you can see right in the middle there, you can see in 1953, 58, tax rates, what's called the marginal tax rate, was up around 90%. When Ronald Reagan was making movies, it was actually that the IRS was taking 94% of every dollar he made above $200,000, and the state of California was taking 6%, if you can believe that. So Ronald Reagan would work 6 months a year and then stop making movies as an actor. Because if he made about $100,000 a film, I know Dwayne Johnson would laugh at that right now because he's making $1 billion. He's in like 7 movies at the same time. It's ridiculous. But Ronald Reagan would make 2 movies, make about $100,000 per film, and then stop working for the next 6 months, because if he worked and made more than $200,000, all of it would go to the IRS in the state of California. You have to work for free. And people don't work for free. My question to you is, could it happen again? What we're concerned with at Renovating Retirement for our clients is, are you prepared for if rates go up again? Because let me go back for a second. If you look right now, and this goes to 2008 on the right-hand side, rates are hovering, marginal tax rates, the top one right now after the Trump changes is something like, 35%, 37% in that range. That's pretty darn low for what it's been for most of our history. I know we don't like to pay taxes. They feel high. But could it happen again where the government raises taxes? Well, if they've been as high as 94% in the past, is it possible for that to be, happen again in the future? This is a couple of months ago. I grabbed this from the internet, but there's that U.S. national debt clock. and it says we have, $21 trillion or whatever it is of debt, and it's rolling up and rolling up and rolling up every day. So right now it's about 65,000 per person or per citizen. That wasn't the case when tax rates were at 94%. We're in a worse situation today than when rates were super high in the past. So is it possible to happen in the future? It is possible. I'm not saying it's going to happen. I don't attempt to have a crystal ball. I'm just saying a good retirement plan is going to be ready for this. We want you to be ready for this. And the kind of things that you need to plan for as far as taxes during retirement. And if you're in retirement now, that's fine. We can still help you. If you're preparing for retirement, we can help you as well. There's just two different strategies. You want to be prepared for taxable distributions, taking money out of IRAs, 401ks, 403bs, TSPs, things like that. Remember, the arrangement was save taxes when you put the money in and then pay it when you get it out. So you're postponing the taxes and you're postponing the tax calculation to whatever percentage the IRS chooses to take at that time. We also want to be ready for RMDs. When you turn 70 and a half, thank you IRS for such easy to remember numbers, 70 and a half, you have to take money out of these things. They want you to take money out of your pre-tax accounts before you pass away. So we want to be ready to do that. Whether you need the income or not, we want to get it out with as little taxes or possibly no taxes. Also, you want to be ready for this thing called the tax torpedo. We'll do more trainings on this, and we certainly will talk to you as we work with you one-on-one about the tax torpedo. But this is a seriously unfortunate situation in the IRS tax code where if you take money out of IRAs, 401ks, 403bs, TSPs, things like that, if you take money out of things that are pre-tax, accounts that haven't been taxed yet, and create this tax, it raises what's called provisional income. It allows the IRS to then tax your Social Security. So if you really look at the big picture, the IRS came up with the idea of the 401k, the 403b, and the IRA. They came up with the idea of giving you a tax deduction today, putting money in and waiting until later until it's taxed. And then they wrote into the code that if you take money out of those, they're then allowed to tax your Social Security. It really was never a way for you to save taxes. This whole qualified plan or pre-tax, post-tax IRA, 401k thing has always been about the IRS creating tax revenue for themselves. That doesn't make them bad. That's their job, raise tax revenue. We just want to play the game well, and games are fun. If you have awesome players on your team, I'd love to play basketball with Michael Jordan. And if you know the rules, I don't enjoy cricket because I have no idea what's going on. I like baseball because I know what's going on. I like soccer because I understand the rules. So we want to be the great players on your team and help you play a game where you know the rules. We also want to be ready for capital gains taxes. And this particular webinar is not on capital gains taxes, but we can show you if you have appreciated real estate, stocks that have gone way up in value, businesses that you're going to sell for big profits. We can show you how to take control of those capital gains, not pay them all in 1 year, and spread them out over the rest of your life or postpone them and have your heirs take care of them. We can put you in control of capital gains taxes. So we have this client. It was a Hawaii client. We do business nationally all over the country. We have a Hawaii client who came to us and said, I'm paying so much tax and I have no idea if I can retire. And I said, well, just tell me about your situation. She said, okay, here's the situation. We have one property we live in and 4 rental properties, so 5 pieces of real estate total. And we don't owe any money on them, so no mortgages. And we have about $600,000 in IRAs and then Social Security coming in as our sources of income. So the sources of income are taxable IRA distributions, Social Security, which I just mentioned is allowed to be taxed if you take enough money out of IRAs, so theirs was being taxed. And then they had 4 rental units with no mortgages to offset the income, so it's straight taxable income on the rentals. Basically, they had just a ton of income that was taxed and no deductions because they had no mortgages. And I said, this is really easy. I mean, I could fix this in my sleep by snapping my fingers. This is what we've been doing for 14 years for over 1,000 different families. It's just unconventional. I'd probably have you sell 4 of the properties and buy 4 new ones, or refinance those 4 properties and buy other ones. In some way, I want you to create deductions, get mortgages and have deductions to offset some of that income, and let's convert the IRAs to Roth. Anyways, just snapping our fingers, keeping their expenses exactly the same, we could eliminate most, if not all, the taxes in that person's life. But here's my disclaimer. If you keep doing what you're currently doing, you're going to get the same results you've always got in the past. So you're going to have to learn something different or use tools differently. The traditional financial plan says pay off your mortgage, postpone taxes to a later date, and put your money in stocks, bonds, and mutual funds, but spread it around so it's what they call diversified. When we went and studied all three of those and said who said it first, who benefits from it, is it still true today as a company, Renovating Retirement, we found that we didn't agree with any of those. That in today's situation with low interest rates, taxes most likely going up, the stock market not performing that well over the last 10 years or 12 years or 20 years, we just don't agree with either of those. So if you're open to learning kind of a contrarian view, you're going to have much, much better results. So the first question for you is, do you have a tax plan that's going to reduce or eliminate every possible tax you may have to pay in the future, or if you're in retirement right now? The goal is to be in a 0% tax bracket, because if they do have to double taxes, or the IRS doubles taxes, like David Walker says they need to, well, 2 times 0 is 0. So we want to help you be in a 0% tax bracket, or at least lower your taxes. So the first promise was we're going to help you lower your taxes, and we can do that. The second one was to give you more income, and it's 10, 20%, 30% for some people, more retirement income than you're currently getting or you're currently on schedule to get. We can snap our fingers and get you 10 to 30% more income. How do we do this? Well, first, let's start with the basics. Retirement planning has always been about income replacement. If every American received, $10,000 a month when they retired from, Social Security or whatever, people would save a lot less money. The reason we save up chunks of money is that we know we're not going to have enough income when we retire. We're going into 30, 40 years of unemployment, so we have to take those chunks of money and turn them into paychecks. It's always been about income replacement. So most of our clients come to us. The way that Renovating Retirement gets most of our clients, why people pick us, why they leave the popular brokerages that have offices all over the place in the strip malls, or the person that you've been working with for 10, 20, 30 years and are comfortable with, the reason most people leave that, trusted advisor, so to speak, and switch to us is really from one simple question. We like to ask, would you like your income to stop when and if you run out of money, or would you like it to continue forever? You see, the old model, the brokerage model, the diversified portfolio, the asset allocation, what you've come to know, kind of getting a statement in the mail with a pie chart of there's times when the market goes down, there's times when the market goes up. Sometimes it looks great, sometimes it doesn't. But that old model, what's missing in that old model is that when you switch to retirement, needing to spend your money down for the rest of your life, that old model can't guarantee that you're not going to run out of money. And that's one of the scariest things we find when we interview people is once they stop working, they don't want to run out of money and have to go work somewhere else, in a store or something like that. They want to make sure they know they have their income. And plus, your income really needs to be going up for inflation so you can pay for more things, not at risk of disappearing. So if you want income that lasts forever, we do that, and very few people do that, and that's why most people choose us, is we're not using a risk model. We don't think hope is a retirement plan. We think a paycheck is a retirement plan. How realistic is it to run out of money? Charlie, what are you talking about? Do people really run out of money, or could this possibly even happen to me? Doesn't the stock market just always take care of everybody? It makes, 7, 8, 9%. Let's just take a peek. And if you look at the blue, the red, and the green, sequence of returns is kind of a geeky term. You don't have to worry about the term. It just means if you're going to make a certain percentage, what order does the market give it to you in? So if you look at the second column in the blue, second column in the red, second column in the green, kind of to the right of where it says year, you see the return is 8.25% for all three scenarios. You've got Steve, you've got poor Bill, and you've got Jim. All three of these people over a 20-year period are making 8.25% on their stock portfolio. And that sounds awesome. And we know the brokerage firms have used that for years to get people to not use the safer tools or guaranteed income tools, because they say, listen, if you want some really great returns, just come over to the market. We'll take some risks and manage it properly, and you're going to make, 8, 9, 10%. So if your broker could actually make you 8.25%, what I want you to understand, what is a concern for us at Renovating Retirement, is it's not whether you make it or not. The broker can actually, do a perfect job and get you exactly what they promise as far as return, but the order that the market gives it to you in is an issue. If there's a lot of returns in the beginning and then the losses, or a lot of losses in the beginning and then the returns. So if you look at the blue, we have the true order the market gave the returns from 1990 to 2009, negative 4.34, 20.32, blah, 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 blah. And the original balance on the very right-hand side of the blue says $500,000. There's $30,000 a year coming out for all three of these people. And if you go all the way down to the bottom of the blue column for 2009, 4 columns over, it says $822,000. So while taking $30,000 out of this portfolio that started at $500,000, this guy, Steve, ends up with $822,000. He experienced growth while taking distributions, and that's because he was given the returns, the 8.25%, in a very favorable situation. If you divide 30 into 500, you can see he's taken out about 6% per year, but he was making 8.25% per year in a good way, in a good order. Therefore, his account grew. The problem is the order that the market gives you returns. Now, the market doesn't guarantee 8.25%, especially with 10,000 people retiring a day. But if you could make 8.25%, the problem is the market could give it to you in different ways. So Bill, in the red columns in the center, all we did was reverse, do a little bit of changing. We took the last 10 years from 2000 to 2009 and put them in there first. And then we took 1990 and on and put them second and said, well, what if you had the last 9 or 10 years first and then the other? Basically, we're just switching up the order. There's an infinite number of ways you can do this, but if you look at Bill's balance on the right-hand side, taking the same 6% withdrawal, the $30,000 a year off of $500,000, Bill's actually out of money by 2006, or let's say how many years would that be? He's out of money by 9, 10, 11, 12, 13, 14, 15. He's out of money in year 16, and he still made the 8.25%. Now, Jim didn't run out of money, but his $500,000 went to $118,000, and somehow he has to live on that for the next 10 or 20 years if he can. The issue we have, we're not saying the market is bad, we're not saying brokers are bad. We're just saying when you switch to where you're taking income out of your account, leaving it all in the market where it may or may not deliver 8.25, but more importantly, where you don't know how you're going to be delivered those returns, is a problem. We don't want to gamble with income. You want income to be set it and forget it, and hopefully set it and have it increase. So sequence of returns is a fairly big deal in retirement planning. Now, another piece to take a look at here is the 3 different types of income that we've looked into. And good income would be income that lasts forever. The number one improvement we want to make in your life, or the starting point, the basics, just kind of laying a foundation, is let's at least get your income where no matter what the sequence of returns are, you can never run out of income. So income that lasts forever. This is why most people pick us, because that's our specialty, not just gambling and hoping for good returns. What would be better than income that lasts forever would be tax-free income that lasts forever. Yeah, we like tax-free income here. So avoiding taxes or getting them down to 0 or cutting them in half, whatever we can do. Some people we can do more for. If you have a pension, it's a little bit harder. But if you don't have any pensions, we can get you into that 0% tax bracket. Having tax-free income that lasts forever is even better because you're keeping all the income and not sharing it with the IRS. The ultimate, the holy grail, the best, would be tax-free increasing income that lasts forever. Now, if we were sitting live instead of a webinar format, I'd ask, why is increasing income so important? What are we trying to protect against? And you may be thinking this already, but really what we're trying to protect against is inflation. The same milk, the same gas, the same bread, the same restaurants and movies tend to go up in price over time. So fixed guaranteed income is awesome, but guaranteed increasing income is better. And if you can make it tax-free, it's just absolutely awesome. So one of the things we'll ask when we meet, we do business nationwide. So we do all of our business over phone and webinar. That's kind of on purpose because we looked into the big brokerage firms and found that the offices cost them so much money that what they were doing was passing those costs through to you in their fees. And if we got rid of all the offices, it's nice to kind of walk into a place twice a year and shake somebody's hand and have a water bottle. But we found that if we took that away and did business by phone or by webinar and just gave you the data and give you the best retirement plan on the planet without the office, we could actually hand you 10 to 30% more income, much less risk, and help you, pay our staff to help you lower your taxes as well. And that seemed more valuable to us than having 12,000 offices or something like that. So when we do meet, we're going to ask you to send us a copy, or at least have a copy of your current written income plan in front of you. Whatever written income plan you have that your current advisor has given to you and your spouse that says, here's how we know you're going to be taken care of from the day of retirement until you live till, if you were 110 or 120. So we're just going to ask you to have that available when we do actually talk to you. Now, let's talk about growth a little bit. Try to finish this sentence here. More risk equals what? When you take more risk, you're supposed to get more of what? It used to be that more risk equals more reward. And so what I have on the screen here is I'm just showing you a calculator. It's called a compound annual growth rate calculator. I'm sorry that's such a mouthful. It just means, how does the money actually grow? What's the real rate of return that it grows at? And if you look at from 1970 to 1999, the annualized return, or true CAGR, if you kind of look in the middle there, is about 13.78, and that's awesome. No wonder people were saying, don't put your money in the bank, don't buy safe products, annuities, life insurance, don't do just real estate. No wonder they said the stock market was the place to be. 13.78 compounding for 29 years is absolutely stellar. No wonder the market gained a good reputation. That's not our concern. I'm not concerned about the weather from 1970 to 1999. I'm not concerned about traffic from 1970 to 1999. If I want to go out tomorrow, I look at the weather for tomorrow, and I look at the traffic on the route to the place that I'm going to. I don't care about the past data. The issue we're having at Renovating Retirement, and what we want to share with you, is that from 2000 to 2017, so 17 years recently, the market only grew at a 5.37% rate. It's actually compounded and earned lower returns than the competing safe alternatives. I know you may not know where those safe alternatives are, but our team will just show you that. So if more risk doesn't equal more return, then do we really want to be risking that hard-earned capital? Picture for a minute your money went down by 20%, which happens in market adjustments. If you convert that to time, it makes you a little bit sicker to your stomach. Say, how long did it take me to save this money? Okay, I worked for 32 years or whatever. Okay, I just lost 20% of it. I just lost, 6.5, 7 years of my savings, and I can never get it back. And I'm taking an income out of it while it's down, which further compounds how much I'm losing. So the concern is that most recently, more risk has not been turning into more reward. And whenever economic conditions change like that, we need to adjust with the times. So we're just trying to be honest and stay up to date and say, well, if more risk doesn't equal more reward, then we don't want to do that. One of the things to look at is something that's been true for decades. It's just not been popular. So you've probably not heard this. And a lot of financial advisors don't want you to do this because it doesn't pay as well. But some of the accounts that exist out there, the different places you can put your money, some of them have 100% risk. This is probably what you're used to. It's kind of the normal stocks, bonds, mutual fund portfolio. If the market goes down 30%, you lose 30% of your money. You probably saw that in your 401k in 2008 and 9. That's the normal, what most people are used to. What people don't realize is that you have two other options. One of these other two options may be a better fit right now if more risk is not equaling more reward. You can choose limited risk. Most people have never even heard of this, but if the market goes down 30%, you can choose to have an account that says the most you can ever lose is 20. Actually, you set it. You can say 10, you can say 12. You actually just pick a maximum loss amount and say, I don't want to lose more than 15%, and you get that type of account, and now your losses are capped or limited, and it changes what you can make on the upside, but they still work very, very well. Some of these outperform the market over the last 10, 15, 20 years. And then what's become really popular among retirees, because once you stop working, you want to be done forever and never go back to work again. No risk. If the market goes down any amount at all, you don't lose any money. Now, I know that sounds too good to be true, but we've now had this for over 20 years. There are accounts, now hundreds if not thousands of them, that say you can make money when the market goes up. We can tie you to the stock market, S&P 500 or NASDAQ or Russell or whatever. And when the market goes down, you won't lose any money at all. You're completely capped with no losses, and then you still get a super healthy portion of the gains. I've gone back personally and tracked these no-risk accounts over that same time frame from the year 2000 to 2017, I actually found that they made about 38% more returns. The accounts grew at about 38% more than the actual stock market. So my personal opinion, and what everybody that works at Renovating Retirement knows, and they can share the research with you, is that when more risk does not equal more reward, let's just take a break. Let's not use the risk strategy. Let's wait until risk is paying 13, 14, 15% again, and then we'll jump back into it. So that's one of the things we're going to share with you, whoever you talk to on the team. We're going to look into your accounts, find out, do some really deep work with you and find out what type of accounts do you have? And are you aware of the other options that are out there? In whatever state you live in and the size of your account, we're just going to say in your state and for this size accounts, you've got these options, these no risk options, limited risk, and of course you understand 100% risk, but we're going to show you the ones that you're probably not familiar with. Now, meeting with us, let's wrap up this webinar. Meeting with us works like this. What we'd like to offer you, what we do at Renovating Retirement in this movement where we're trying to change the world, is we're going to review your current tax situation and we're going to build a tax plan for you and with you. We want you to be ready for whatever happens in the tax scenario and help you to reduce those taxes starting immediately. We also want to review your current income plan and build an income plan for you. So a lot of times people either come in with no income plan or they come in with an income plan that's just hypothetical, that says here's what you can probably take. You can probably take $30,000 a year out of $500,000 account. It doesn't matter how much money you have. I'm just using the example from earlier. And then we're going to say to you, okay, but if the sequence of returns comes in differently than expected, you run out of money in 16 years, is that something you're willing to risk? Most people say no, and that's why I say we get most of our clients by asking one question, which is, would you like forever income or would you like maybe income? Do you want to gamble? The gambling from 1970 to 1999 gave you a lot of money, a big nest egg, a big chunk of money, because that's when money or the market was compounding at 13.5%. Gambling worked pre-2000. When it's time to take an income out, we don't want to gamble because the odds are stacked against you and it may not work. And if it doesn't work, you don't have the time to recover and you have to go back to work, which is not very comfortable. So we're going to help you build an income plan so you have a guaranteed income plan in your life. The other thing we'd like to offer is to review your current risk levels and what strategies you're currently using and help you to minimize your risk of losing money, or possibly, some people just like to eliminate all the risk in their life. They just say, Charlie, or whoever you're working with, I don't want to lose money anymore. My risk tolerance is 0. I saved up what I can save up. I don't want to go back to work. When the market crashes, I don't want to care. I don't want to watch the news. I just want to go play golf and visit my grandkids and eat bonbons or whatever you're going to do. You don't have to have risk in your life. And when risk isn't paying very well, we recommend that people have less of it. So there's a storm coming. People in New Orleans for Hurricane Katrina. There was also a huge storm in Houston. There was the big storm in the Jersey Shore. There were the volcanoes in Hawaii, fires in California. When someone knows a storm is coming, you can get ready for it, right? There's a calm before the storm. But you can get ready. You can stack up bags of sand. You can board up your windows. You can hide your valuables. You can, stack up on food and things like that. But, there's a storm coming to the market. So many people, the same baby boomers, same group of people that drove the market up while they were working are now retiring. And they're taking money out in big chunks either for income or to move to these safer strategies because risk is not given as much reward. And they're realizing it. We know there's a storm coming with taxes. Taxes kind of need to go up. The country's in trouble. And we have had some changes where there were some short-term reductions, but they're not going to last forever. The most intelligent people that we listen to say taxes may even need to double. So we don't know if they're going to double, but it seems like they need to creep up. And we know that storm's coming. We just don't know when it's going to hit. Now's the time to prepare. Now's the time to protect your assets from losses and to start to move yourself into a lower tax bracket or start to get that divorce from the IRS and make sure that no matter what they raise the tax rate to, that you don't have to pay taxes on your income because maybe we can get you in a 0% tax bracket. So that's really the passionate message. There is a storm coming, but we don't know when, but you've been blessed with knowing that it's coming ahead of time. You're either going to have good news with us or you're going to have good news with us. And here's what I mean by that. And here's why we've had so much success and so many people switch over to us. If you really did meet with one of our advisors and you're talking on the phone or you're doing a Zoom meeting or some sort of a video meeting with them, and they find that you're doing everything perfect in your life. You're in a 0% tax bracket. You've got guaranteed tax-free increasing income, and none of your money's at risk. That's probably the perfect financial plan. We're just going to pat you on the back and say, you're awesome. Matter of fact, we'll probably interview you on the podcast and teach other people and help them learn from you. So you're going to get a bunch of fame and praise and a pat on the back. And wouldn't you sleep better at night knowing that somebody who's the best of the best in the industry reviewed your financial plan and said, there's nothing you could do better than this. You're awesome. So you're either going to get really good news and feel really good about yourself, or you're going to get the good news of our advisor coming along and saying, you've done an amazing job, and I found a way to make it even better and have you pay lower taxes, have more income, all of that with less risk. It's an incredible process. Everybody loves it. You're going to get good news or good news. Now, how much is all this going to cost you? Right now, and this could change, we're looking at changing it really, really soon, but right now, the way we've done business since we started, there is no cost for this. The person who trained me in the very beginning when it was a one-person company, and now the way we still do it, now that we're national and work in every state, the way we do this is say, let us take a look at what you're currently doing. And if there's any way we can make any improvements on your situation, we're still not going to charge you a penny. We're going to make the companies that we use pay us. So far, everybody's loved that model. I used that model when I was a realtor. I love to help people buy homes because as a buyer's agent, I didn't have to charge them any fees. I've always sold free very well. That's just the offer that we have right now, and we're going to change it in the future. But for now, if you get in from this webinar, we're not going to charge you a penny. We're going to have a very comfortable, awesome conversation with you. Just go, what are you currently doing? Show me your current income plan. What's going on with your taxes? How much risk are you taking? Who have you been working with? Do you like them? What do you like about them? What do you not like about them? Just dig really deep with you. You have a friend in the industry, in us. We know what's going on in this industry, and we can help you navigate everything and make each part of your financial plan better. We're here to help you. We're going to wrap up this webinar. I'm going to answer questions here. If you want to get in contact with us, just type contact at renovatingretirement.com. If you want to email us, just say, hey, I would like some help. Give us your name, your phone number, whatever. Or if you just want to call right into the office, you can use the 800 number, 888-285-2268. What I want to tell you is after reviewing 1,000 financial plans and then taking this company from just me to national, building a podcast with over 100 episodes, being on TV, writing books, being interviewed by other experts, what I want to tell you from my 50,000-foot view is that there's definitely a storm coming. Taxes are an issue. Most of the people we've met are getting 10 to 30% less income than they deserve, which means they did all the hard work of saving over 30 to 40 years, and now they're punishing themselves by not getting what they deserve. And everybody we meet, with very few exceptions, is taking more risk than the rewards they're getting would warrant. So our promise to you is we can lower your taxes, increase your income, all by lowering your risk. If that sounds good to you, get in touch. Contact at renovatingretirement.com or 888-285-2268. My name is Charlie Jewett. I hope this helps you tremendously. God bless you guys. Bye-bye.